Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding Yield Curve Analysis, a key to smarter investments. Ever wondered why economists and investors keep an eye on the yield curve? It's a key tool for understanding economic trends and predicting shifts in the financial market. Yield curve analysis examines the relationship between interest rates of bonds with different maturities. The yield curve can tell us a lot about investor sentiment, future interest rates, and economic growth. By studying the shape of the yield curve, you can gain insights into market expectations and potential risks. Is the economy headed for a recession, or is growth on the horizon? This video will unravel these questions, helping you understand why yield curves matter and how they impact your investments. Stay tuned as we break down the basics and dive into the nuances of yield curve analysis. What is a yield curve? Understanding the yield curve is essential for anyone interested in finance or economics. The yield curve can help predict changes in economic output and interest rates. Definition of yield curve. The yield curve is a graph that shows the relationship between interest rates and the time to maturity for a set of bonds. Usually, the bonds are government securities. On the graph, the horizontal axis represents the time to maturity, which can range from short-term to long-term. The vertical axis shows the interest rates or yields. Think of the yield curve as a snapshot of how much you would earn on a bond investment if you held it to maturity. The shape of this curve can tell us a lot about economic expectations. If interest rates are higher for long-term bonds compared to short-term bonds, the curve slopes upward. If they are lower, the curve slopes downward. Types of yield curves. The yield curve can take on different shapes, each telling a different story. Normal yield curve. This is the most common shape. It slopes upward, showing that long-term interest rates are higher than short-term rates. This shape usually means that investors expect future economic growth and higher inflation. Inverted yield curve. This curve slopes downward. It indicates that short-term interest rates are higher than long-term rates. An inverted yield curve often suggests that a recession is coming. Investors might be buying long-term bonds as a safe haven, causing the interest rates on these bonds to fall. Flat yield curve. In this scenario, short-term and long-term rates are almost the same. This shape can signify uncertainty in economic conditions. Investors might not be sure if the economy will grow or shrink. Humped yield curve. This curve initially rises, then falls. It's rare and usually signals that the economy will slow down after a period of growth. It suggests uncertainty and mixed expectations about future interest rates and economic growth. Understanding these different shapes can help you make better financial decisions. It's like having a weather forecast for the economy. Knowing whether a storm or sunshine is coming helps you prepare in advance. Importance of yield curve analysis. Yield curve analysis is crucial for understanding financial markets and the broader economy. By examining the yield curve, investors and economists gain insights into future economic activity, inflation expectations, and optimal investment strategies. Economic indicators. The yield curve, which plots interest rates across different maturities, can signal future economic conditions. When the curve is upward sloping, it suggests economic growth and rising inflation expectations. Conversely, an inverted curve may hint at an upcoming recession. Normal yield curve indicates confidence in the economy's growth. Long-term rates are higher than short-term rates. Inverted yield curve often precedes a recession. Short-term rates become higher than long-term rates. Flat yield curve signals economic uncertainty. Short-term and long-term rates are almost equal. These trends help policymakers and businesses anticipate economic shifts. Imagine the yield curve as a financial weather forecast. Just as you plan your day based on the weather, economic agents plan based on yield curve signals. Investment decisions. Investors rely on the yield curve to guide their bond investments and manage portfolios. It helps determine the right balance between risk and return. Bond pricing. The shape of the yield curve influences bond prices. An upward curve means higher returns on long-term bonds. Portfolio management. Investors use the yield curve to diversify portfolios. They balance short-term and long-term bonds to optimize returns and manage risk. For example, a steep yield curve might prompt an investor to buy long-term bonds for better yields. On the other hand, a flat or inverted curve may lead to a preference for short-term bonds to avoid potential losses. By analyzing the yield curve, investors don't just react to the market, they anticipate it. This strategic foresight can be the key to successful investment and financial planning. How to analyze the yield curve. The yield curve is a crucial tool for investors and economists. It offers insights into future interest rates, economic growth, and market expectations. But how do you go about analyzing it effectively? Let's dive into the steps and methods. Data sources. Before you can start your analysis, you'll need reliable data. Here are some trusted sources for yield curve data. U.S. Department of the Treasury. This is one of the most authoritative sources. You can find daily yield curve rates for various maturities. Federal Reserve Economic Data, FRED, managed by the Federal Reserve Bank of St. Louis. FRED offers extensive historical data on interest rates and yield curves. Bloomberg, known for its financial data services, Bloomberg provides real-time yield curve data, although it often requires a subscription. Wall Street Journal offers updated yield curve data and financial news, helpful for a broader context. Having access to accurate and up-to-date data is the foundation of your yield curve analysis. Interpreting the curve. Interpreting the yield curve involves understanding its shape and the changes over time. Here are some common forms and what they might indicate. Normal yield curve. This curve slopes upward, showing that longer-term investments have higher yields. This usually suggests stable economic growth. Inverted yield curve. An inverted curve slopes downward. This occurs when short-term interest rates are higher than long-term rates. Historically, this has been a predictor of recessions. Flat yield curve. When the yields on short-term and long-term bonds are almost the same, it suggests uncertainty in the economy. This might indicate a transition period, such as moving from expansion to recession. Steep yield curve indicates a significant difference between short-term and long-term yields, often suggesting rapid economic growth but also potential future inflation. By observing these shapes, you can infer market expectations and potential economic outcomes. Historical context. Analyzing historical yield curves can provide insights into how they correlate with past economic events. Here are a few notable examples. 2000 inverted yield curve. Before the dot-com bubble burst, the yield curve inverted in late 2000, predicting the ensuing recession. 2007-2008 financial crisis. The yield curve inverted in 2006-2007, serving as a precursor to the financial crisis and the Great Recession. COVID-19 pandemic. The yield curve experienced dramatic shifts as the pandemic unfolded, reflecting the unprecedented economic uncertainty. Looking at these historical instances, we see that yield curves often provide early warning signs for economic downturns. By comparing current yield curves to past data, investors can make more informed decisions. Analyzing the yield curve isn't just for experts. With the right data sources and understanding of its patterns, anyone can gain valuable insights into economic trends. Keep these steps in mind as you explore the curves, and you'll be better equipped to navigate the market. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.